Welcome back to Finance Bros, navigating the risks and riches in Singapore. In today's episode, we'll talk about risk, financial risk, and we're going to explore various types of risks faced by the mass affluent and the strategies to manage them effectively. Let's get started. So, to first understand what financial risk is really all about, let us look at the first definition by Investopedia. So you can see it says it's the possibility of losing money on an investment or business venture. But there is actually a more comprehensive perspective on what financial risk is all about. Maybe I can let Simon share more about it.
Yes, to begin with, let us understand two primary categories of financial risk. So it'll be shown on the diagram itself. There's this risk called systematic risk and unsystematic risk. Okay, so on the graph, you see systematic risk that is on the bottom, and on top of the systematic risk, there's this unsystematic risk. So the definition of systematic risk is also known as market risk. It is a risk inherent to the entire market or an entire market segment. It cannot be eliminated through diversification. So as you can see from the graph, no matter how many stocks, which is the y-axis you see, no matter how many stocks that you own in the market, you can't avoid that systematic risk. So some examples of systematic risks such as economic downturns, interest rate changes, political instability, natural disasters are some of the examples. So just to cite what happened recently that you guys can understand a little. In 2018, there's this US-China trade war, and there are three industries that's being affected by this US-China trade war. The first is automobile. Tesla was being affected because in China, EV is quite prevalent. Yeah, so Tesla entered China, but because of all the US-China trade war, it got affected. Second one is semiconductors. All the big major brands that work in China got affected by that because of the US-China trade war. And third is agriculture. In 2019, we have COVID-19, which is just not long ago. It affects the whole global market. And in November 2020, China big tech firms has this crackdown. So the government decided to do a clean sweep of the industry. And it started all the way from this company called Ant Group launching their IPO. So just quite recent, there's this February 2022 Russian-Ukraine war. Because of the war, the raw materials, the energy, the transportation prices all got affected. And thus, we have this increase in inflation. So that's systematic risk, things that we cannot predict and cannot avoid.
Yep. So as for unsystematic risk, the definition is also known as the specific risk. It's the risk associated with the individual assets or specific sectors that can be diversified away. So example would be a company-specific risk such as the management changes, product recall, supply chain disruption, or these are all examples of the unsystematic risk. And a company quite well known to many, especially if you grew up not in the millennia, you will have heard about this company called Kodak. I guess everybody would have once used their products and services. They basically dominated the film and camera industry for many, many decades, but fell out of favor by screwing up to transform its business. They made billions of dollars selling analog cameras and film cartridges, but they ignored the rise of digital photography. So despite the introduction of the digital camera in the 1990s, Kodak's primary revenue generated remained in photo printing. As smartphones changed how people share photos, social media as well, Kodak stubbornly stuck to their old business model and still continues to promote printing. As a result, in 2012, actually, a company that had once made 10 billion in sales in 1981 has declared bankruptcy. And of course, we have other companies such as Nokia and many more other well-known companies that fall under the same risk before.
That's right. So now we understand how the different types of risks, and now we should discuss what are strategies to manage them effectively. So to manage systematic risk, okay, systematic risk means that risk that cannot be diversified, right? So to manage that, okay, we must spread across your investments along different asset class and sectors. So to reduce exposure to any one of them in terms of systematic risk. So what are the different asset class available in the market? Okay, there are of course bonds, equities, real estates, commodities, cash, funds, investment, and I think up and coming, which is called cryptocurrency. So the asset allocation, okay, is that you have to allocate in different asset class based on your risk tolerance and investment goals. So each asset class behave differently to the event happening in the market. So this is to balance out exposure to different systematic risks. So just to cite one example, that recently I went past a pawn shop, right? 大兴档, those kind, right? And you know, when you go past there, there's this big banner that says how much is the gold price. So all of us know that gold price along so many years, it has always been an expensive range. So it has rise by quite a fair bit. So it has shoot up during COVID period. And even now, the prices are still high. So in 2018, when I was getting married, so you know, in Chinese we have this, you have to buy gold for your wife.
Dowry.
Dowry, 4点金. So the gold price in 2018 was about $50 plus per gram. Recently we walked past and we got a shock. The prices of a gold per gram has shot up to $103. Yeah, so this is one of the reasons why that even if the stocks market are not doing well, the gold prices can do really well. Right. So this is how you manage systematic risk. Okay, to manage unsystematic risk, okay, how we're gonna do that is that we have to invest in various of assets, sectors, and geographical sectors. So it's different asset class, different sectors, different geographical. So to reduce this unsystematic risk on the portfolio. So the easiest way, okay, to avoid all this different homework and stuff, we have to, the easiest way is to invest in index funds. So it will be easier on that. So you don't need to have so many homeworks to be done. We cannot have all the unlimited resource to invest in so many areas as well. So buying into funds will ensure diversification across sector, across asset, or even across geographical. And definitely before you invest, you have to do your research and due diligence. So please conduct your research and analyses before investing in individual asset. Okay, to minimize unsystematic risk. Make sure you understand how the company is doing, how they do business, or simply just get those regular investment plans in the market right now. That's the simplest way. So to conclude, okay, it's important to remember that while systematic risk cannot be fully eliminated, they can be managed through diversification and asset allocation. Unsystematic risk, on the other hand, can be diversified by spreading investment across different sectors and assets.
Okay, so just a little more tips for our listeners. A lot of people view risk in a very different fashion. Most people would think of S&P 500 when it comes to investing in the equity markets, and they would think, oh, risk has got to do with, if anything, that can be in terms of performance not too different from S&P 500 means a low risk. The way you look at risk actually is quite different from the official perspective, and this is often misled in what people share with their friends. So rather than taking an approach of measuring risk based on what S&P is performing, you should obviously be looking at what's your risk threshold. And obviously, what's the risk threshold is things you have to go through a risk of questionnaires to ask yourself, like, are you okay if the market goes down a certain percentage? Is this a big amount of your assets that you're investing in a way? Do you have a long-term horizon and stuff like that? So I think many of these very key processes is what a lot of people conveniently forget to do. And hence, I think it's very important for us to remind you in this podcast that whenever it comes in terms of investment, you should always speak to a qualified financial advisor to really measure up your risk, understand the needs, and also things like time horizon, your returns expected and stuff like that before you jump to any vehicles of investment. Yeah. So today, as we conclude the season 1 of Finance Bros, we want to recap the key lessons we've covered so far. So in episode 1, we introduce the idea of what is affluent individual to everyone on the podcast, and also who constitute to be high net worth individuals. And in episode 2, we talk about the 2 strategies employed by affluent to build and sustain wealth, and talk about allocation of money as well. And the third episode, we were exploring investment basics for the mass affluent, highlighting strategies to grow wealth effectively, and how do we have more passive income. And in today's episode, we delve into risk assessment and management, emphasizing the importance of understanding and mitigating financial risks. So a sneak peek into season 2. We will continue to build on the foundations we've established, focusing on building and protecting wealth. We will also explore topics such as real estate investment, asset allocation, insurance, and tax planning, all aimed at helping you to optimize your wealth accumulation journey. So stay tuned for more insights and strategies to help you achieve financial success. And we want to thank you once again for joining us in season 1 of Finance Bros. We hope you have found our information valuable and insightful. Remember, the journey to financial success is ongoing, and we are here to support you every step of the way. Stay tuned for season 2, and until then, keep striving for your financial goals. Until next time, this is Jimmy and Simon signing off. Yeah. 我们 just 关掉。
Too much of a word.